We had a mixed day in the market yesterday, some companies performing well, the likes of Nvidia, SMCI up 4-5%, and other companies performing not as well, down around 1 or 2 percentage points. Now today we are looking at 5 undervalued stocks near their 52-week lows, and the first one that we have is UPS, United Parcel Service. Now this one has been hammered over the last year, down nearly 30%, continues to be downward trending, and as we can see, right there at its 52-week low. Now we do get a double buy signal with a hold from Quant, and it now has a forward yield that may look incredibly attractive to investors at 5.18%, especially with interest rates coming over the next few months. It also, as we can see, trades at a forward PE of 16.6, and over the last 10 years, if you have been a shareholder, well, you would be up around 28%. Not a great return by any means, but also bear in mind it doesn't include reinvestment of dividends, or that would only have taken up a few percentage points higher. Now, in terms of this company, well, the dividend safety score does sit at 69, so it does look to be safe. But we were very disappointed at the beginning of this year with their growth of 0.6%, well below that minimum 4% that we do target on this channel just to keep up in line with inflation. Now, it was reaffirmed just last month that the dividend is safe, and what this ultimately means is that a dividend cut is unlikely for United Parcel Service. And as always, for all the companies we look at, we like to see some key recessionary metrics from the 07-09 Great Recession. UPS, while they maintained the dividend, didn't increase it, also didn't cut it. They pretty much had bang on average growth of the S&P at negative 12%, and they marginally outperformed the S&P negative 48, with the S&P itself negative 55. Now, not only below the inflationary rate of 4% that we want to see this January, but also much lower than the double-digit increases we have been accustomed to with UPS. We also do note they've got 14 years of consecutive increases, although they have been paying a dividend for the last 55 years without a reduction. Now, dividend yield theory, as always, states a company is undervalued when the current yield sits above the 5-year average. Not only do we have a severe undervaluation signal here, but this is the highest the yield has been for UPS over the last 5 years. We also note the forward PE 15.1 does sit lower than the 5-year of 16.6, and also marginally lower than the industrials of 18.7. We then draw your attention to the free cash flow payout, and one of the reasons why we do prefer this over the earnings, while it is susceptible to manipulation by management through accounting, and also you wouldn't be able to identify any potential dividend cuts by looking at this information. Now, below 60% is our preference. We want faith they can continue to offer double-digit increases like they have done historically. But look, in 2023, this is a red flag indicator. They paid out more in dividends than they generated in free cash flow, something we've seen them also do in 2019, and not something you could have deciphered from looking at the earnings payout. Now, over the next 12 months, it is anticipated to come down to 81%, but still not below the 60 we want to see, so do expect over the next year probably another very mediocre increase to their dividend. Now, free cash flow per share, consistent increases over longer term. Yes, we do see an increase, but do understand incredibly inconsistent. And in fact, from the highs of 2021, it has started to come down. Over the next 12 months, though, it is anticipated to increase to around $8.03. Then sales growth, our particular target is 3 to 7% at a bare minimum. That 3 to 4%, as we always say, just to keep up in line with inflation. And what we can see, pretty much near there or thereabouts over the last 10, bar 2023, their more recent year, where they are down around 9%, and we can in fact see when you do zoom out, they have increased their top line by around 80 to 90%, 58 billion to 91 in the more recent annual accounts. Now, shares outstanding, we love it when companies do share buybacks, returning excess cash to investor pockets. You ultimately have a larger portion of control over the company, something they do not that consistently, and in fact, we also note from 2019 to 2021, they were diluting your position by issuing shares, but overall, the net point here is share buybacks, although fairly trivial, not much to discuss with regards to that. ROIC, one of our favorite metrics, 10% or more, give us faith that management are able to effectively allocate their capital. Now, it has been decreasing over the longer term, but still, over the last 7 years, in the 20s, looks very, very strong, although we do note a small drop to 17% on a trailing 12-month basis. We then look at the operating margin. Around 12% is what we want to see. It pretty much straddles around that on a year-on-year basis. But again, we do ideally want to see both increases to revenue as well as upward trending margins to show us that they can have operating efficiency, not something we've noted. And again, free cash flow margin, whilst inconsistent, more often than not above that 5% minimum level. We then get to the net debt to EBITDA, EBITDA referring to the earnings before the interest, tax, depreciation, amortization. Below 3 is what we want to see. Below 3 every single year. Remember, the numbers below that you are looking at are the number of years it would take the company to pay off all of their debt net of cash on hand. And we focus on this metric because it correlates to both dividend safety, balance sheet strength. 1.58 in 2023 does look to be good. 1.54 over the next 12 months as well. Very minimal movement, so it does look positive. But do remember that free cash flow payout does look a little bit questionable, so something to consider. Now, jumping into the valuation model, as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically when we do our deep dives, we run through every single model. Today, getting straight into it, our intrinsic value of $146 with the current price at $125. We always like to elect a margin of safety. 10%, we use that if it meets the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that for UPS, a buy at $132, then we keep going till it's near the current trading price. Right now, we see it trading at a 15% MOS, something that may be attractive to dividend investors who also like this very nice yield. And in fact, Wall Street are very bullish in terms of the upside. Their price target 159. At this point in time, they see 27% over the next year. As always though, do let us know your thoughts as we go along these dividend stocks today. We also want to let you know we have released our latest free weekly article. If you want access to this or any others, you can click on the pinned comment below, sign up and read straight away. We have also released our 35 undervalued stocks for the month of August, and we also run through those that are in our own portfolios currently as well. So do check that out by clicking below. We then move on to the next 52-week low stock, CVS Health, with a buy from Wall Street and a double hold. As we can see, trading right there towards their 52-week lows. Another very attractive yield, 4.7% with a forward P of 8.4. Now, over the last year, it is down around 25%. Over the last 10 years, in fact, down -30. But as always, it will depend at which point you did buy the shares. And we can see one of the more recent highs sitting over the $100 mark just around 2 years ago. Now they have a safe dividend with a score of 80. In terms of dividend growth, well, 9.9% just in December, something we do love to see. And when we do talk about the key recessionary metrics, well, unlike the first company, UPS, they actually increased the dividend. They had above average growth and also strongly outperformed the S&P with their -38% return. Now, a very nice increase, as we mentioned in December, 4% over the last 5 years, so at least keeping up in line with inflation. Over the last 20 years, looking very strong, 16% year-on-year increases, and we can see 2 years of consecutive increases as they did maintain it just over the shorter term, but 27 years of paying a dividend without a reduction. Now we get another double undervaluation signal, both on the yield as well as the forward PE, and similar to the previous company, we have a triple undervaluation signal as healthcare does sit, in fact, in this case, significantly higher. Then we get to the free cash flow payout where we want below 40%, being specific for consumer retail industry, 30% in 2023, in fact below 40 over the last 10 years, over the next 12 months as well, anticipated to be the same, although marginally creeping higher to the 38% mark. Then when we look at the free cash flow payout, whilst it has increased, a little bit inconsistent, it is nice to note though overall it does move in the right direction. Over the next 12 months though, we are expecting a small drop to around $7 per share. Then we get to the sales growth, actually very, very strong in my opinion. Double digit for the majority of the last 10 years, 11% over the last 2. And when we do look at it from a numerical standpoint, we can in fact see more than doubled, nearly tripled their top line over the last 10. But unfortunately, with the shares outstanding, they would have diluted your position fairly significantly over the last 10 years. But we can see from 2021, they have started to do some share buybacks, although fairly minimal. Then we move on to the ROIC, where above 17%, so it does go significantly higher for consumer retailers. Not something they've achieved over the last 10 years. Over the more recent years, 9 to 11%, not too bad, but if we could get it much higher, around the 17% level, this would make this company significantly more attractive. We then get to the operating margins. Now, yes, above 10% is what we want for consumer retailers, but when we have reviewed this industry as a whole, their margins are very low. The only thing to think about here, maybe incorporate it into your margin of safety, is that the margins have been decreasing 6% down to 3% on a trailing 12-month basis. This will affect that bottom line profitability. In terms of the free cash flow margin, not what we want to see, around 6% or more, and again, fairly inconsistent. We then finally get to the net debt to EBITDA. Below 3 is what we want to see. Near or thereabouts over the longer term, 2.94 in 2023, 3.37 over the next 12 months. Definitely something just to think about. Doesn't mean it isn't a good company to invest in, but there are some metrics that maybe you want to apply a larger MOS to. Now, our intrinsic value of $73 isn't dissimilar from Wall Street's 72, where they see 24% upside. And as always, you can grab a copy of this model by clicking on the pinned comment below and running in your own numbers, whether it's for CVS or any other company. So 10% would give a buy at $66. And as we said, we keep going. And in today's episode, you're pretty much getting a 20% margin of safety based on those estimates and judgments. Now, it may not be sufficient, or maybe it is, depending on what type of investor you are and your investment thesis. For those looking at 25%, it would be around $55, and those at 30, around $51. As we said though, in today's episode, 20% margin of safety with 24% upside according to Wall Street. We then move on to Occidental Petroleum, where Warren Buffett has been buying a significant number of shares continuously over the last few years. We have a buy rating from Seeking Alpha, a double hold, and trading right there towards its 52-week lows. We get a yield lower than the first two at 1.51, with a forward P sitting around 15.3. Now, over the last year, it is down around 10%. Over the last 10 years, in fact, down 40%. But as we mentioned, it will depend at which point you bought. The lowest point was around that COVID crash, trading at $10. You would be up nearly 6 times right now if you had held on. Now, dividend safety sits at 60, so borderline safe, and we do love to see this strong double-digit growth just in December at 22%. Now, what does a essentially borderline safe score mean? Well, as we can see here, moderate risk of a dividend cut over a full economic cycle. Now, in terms of the key recessionary metrics, well, they increased it during the last recession, below average growth, but significantly outperformed negative 23%. Now, whilst we did love their increase in December, we can see they have cut the dividend, hence why over the last 5 years, negative 25, over the last 20, just 2%. As we mentioned, you really want to be seeing a minimum of 4%, and that doesn't just relate to your dividends, that's also your other income producing assets, your salaries as well, because then in effect you are losing your purchasing power and taking a pay cut. So they have had 2 years of consecutive increases. Now, in terms of dividend yield theory, we get that massive undervaluation signal, 1.49 versus the 5-year 0.88, but we do note the forward P of 13.5 does sit higher than the 5-year average of 9.7, and in terms of the energy sector at 12.3, Oxy does sit marginally higher. Then when we get to the free cash flow payout, bear in mind oil and gas is a very cyclical industry, so we don't expect too much consistency. Below 40% is what we want to see. We get that significantly over the last 3 years. Into the next 12 months at 14% anticipated, we would expect another very strong double-digit growth from Oxy moving forwards. In terms of free cash flow, whilst it has increased, again, that inconsistency does show itself, and over the next 12 months, it is anticipated to drop marginally to around 615. Sales growth, again, in fact, 5 of the last 10 years have been negative growth, negative 23 as well in that more recent year, and it is clearly shown when we do look at the total sales, 19 billion in 2014, down to the lows of 10 billion in 2016, and then hitting the highs of 37 in 2022. We also note over the longer term they would have diluted your position, but from the highs of 2022 they have started to do some share buyback. Then we get to the ROIC, around 8% or more for oil producers. We get that over the last 3 years, so that is nice to know. Would like to see some consistency, but again, that is a little bit hard when you are dealing with cyclical companies. We then also note both on the operating margin as well as the free cash flow margin looking very strong over the more recent period. However, when we do look at it over the last 10 years, we do note some negative margins as well. Therefore, they would have made a loss some of the years over the last 10. Net debt to EBITDA, we want below 1.5 for oil producers. Not something we see a lot over the period. 1.28 though, nice to see that in 2023. 1.06 over the next 12 months. So it is moving to a stronger balance sheet over the next year. Now in terms of the valuation, we get to a $75 mark. Wall Street a little bit lower at 72.07, so they see 22% upside. Margin of safety, 10% a buy at $67, 15% a buy at $64, at the 20% around $59.95. So you could argue around the $60 mark. If this does interest you, it is one you want to hold in your own portfolio, while you do get a 20% MOS now with 22% upside. We then move on to Hormel Foods with a triple hold rating, again trading towards the lower end of the 52-week range. You have a forward P that sits just below 20 and another nice forward yield, 3.53%. Now hammered down 24% over the last year, and if you've been a shareholder over the last 10, you would be up around 27%. One of the more recent highs we do see around the $53, $54 mark. Now they have a very safe dividend score sitting at 90, and they did increase the dividend in November last year, 2.7%, again, not something we really want to see on this channel, and a very safe score ultimately means that a dividend cut is highly unlikely. Now last recession, they increased the dividend, they had above average growth, and they significantly outperformed the S&P, negative 15% recession return, and we also note over both the last 5 and the last 20 years, some very strong growth. Now something we haven't mentioned but will bring to your attention now, this is a dividend king. They have increased those dividends for 50 plus years, something we always love to see. Now dividend yield theory shows a strong double undervaluation signal on the yield as well as the forward P, but we do note it does sit higher than consumer staples, which right now sits at 17.3. Now when we look at the free cash flow payout, we bring it up for consumer staples to around 70. We note over the last 5 years, it has been around that 70% level, but we want to point out over the next 12, it is expecting to creep higher to 81, just something to consider. We then move on to the free cash flow, which does look fairly consistent over the longer term, maybe not as much growth as we want to see, and over the next 12 months, very minimal movement to around $1.40 from $1.42. Now, sales growth, not something you want to see from consumer staples, but 4 of the last 10 years have been negative growth, as well as negative 3% in the full year of 2023. We do also note we can see growth on the top line going from 9 billion to around 12, so we see here just under 50% over the period, with very marginal increases over the longer term, so they have diluted your position as a shareholder, but again, very, very trivially. ROIC now above 12% for consumer staples, not the greatest when we see them decrease. Ideally, we want to see it increase, but 9 to 11% over the last 2 years isn't too bad. Just don't want that trend to continue downwards. As we said, 10% really, from a general perspective, is the ideal minimum. Margins, well, above 16%, not something we have seen. In fact, decreasing from the highs of 14% in 2016 to around 9%. So something to consider. Maybe again, put it into your margin of safety. And above 7% for the free cash flow margin, pretty much straddling around that on a year-on-year basis. Now, net debt to EBITDA, it does look very good in all honesty, because we want below 4 for consumer staples, 1.36 in 2023, 1.14 over the next 12 months. So balance sheet does look to be strong, and one of the reasons why we did see that very safe dividend score. Now, our intrinsic value of $35 is marginally higher than Wall Street. They have 34 with upside of 6%. In fact, they do believe this is a hold, and when we run it through the margin of safety at 10%, it is pretty much around the $32 mark. So right now, for a dividend king, you are getting a 10% MOS, minimal upside as we can see, but again, it will depend whether or not over the longer term, maybe you want to add more dividend kings into the portfolio. But one thing that we would say with that, just because a company has increased it over the last 50 years, it doesn't mean they won't cut that dividend. We have many examples that we have discussed on this channel. We then move on to Darden Restaurants with a buy from Wall Street and a double hold. It is trading right there towards the lower end of the 52-week range, with a forward yield near the 4% mark and a forward P sitting around 15. Over the last year, not great, negative 12%. Over the last 10 years though, the first one we have talked about today that has significantly outperformed the S&P, up 234%. It also has a safe dividend score of 70, with a nice increase just recently June at 6.9%. Now, in terms of the last recession, well, they continued to increase that dividend. They had above average growth at negative 1%, and they did also outperform the S&P, negative 44. Love to see this as well. Very strong growth, 12% over the last 5 years with 23% over the last 20. And we do know, in fact, 3 years of consecutive increases as they did cut that dividend during the COVID period. In terms of looking at dividend yield theory, well, no surprises, a strong undervaluation signal on the yield as well as the forward P. And when we do compare it, consumer discretionary does sit fairly low at 12.6 in comparison. Then we look at the free cash flow payout, where we want to see below 50% for restaurants, around the 60s over the last 3 years, pretty consistent over the next 12. So this does indicate to us that we should see a nice mid to high single digit increase moving forwards. We also get, whilst inconsistent, strong growth to the free cash flow over the last 10 years. Over the next 12 months, again anticipated to continue to 894. Then when we look at the sales growth, well, 3 to 7%, 2 of the years have been negative, but the last 3 years have been very strong, consistent 9% in 23 and 24. And when we do zoom out, nearly doubled their top line from 2015 to 2024. Very, very minimal movement across those shares outstanding. They've bought back around 9 million shares, so not much to discuss. And when we do jump into the ROIC, we want to see above 12% for restaurants, and that is what we get pretty much 7 of the last 10 years. Very consistent over the last 3, 14, 14, and 14. Then we look at operating margins, one area that across the board in the restaurant industry, they do lack significantly. But the positive to say here is it has gone from 6% to 12% over the last 10. And nice to see for the majority of the last 10 years, higher than the 5% minimum on the free cash flow margin. Then when we get to the net debt to EBITDA, below 3.5 is what we want to see. Over the last 3 years, that is what we get. 2.91 in 24, 2.79, so anticipated to go lower. So lots of good signs, but also some considerations to take in with DRI. Now our intrinsic value of $172, not far off Wall Street's 171, where they do see 20% upside. And when we run it through the MOS, well, 10% a buy at 155, at 15% a buy at 146. Not quite at the 20% level yet, so you could argue for Darden restaurants 15 to 20%, with Wall Street indicating 20% over the next year. As always, let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified as they drop. Don't forget to sign up to the free weekly newsletter below, and also come and join us in the Patreon if you do want to talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.